Hello everyone. My name is Anjani Kumar Khetan. I am based out of Bangalore in India. And in this particular video, we will continue our deliberation from the previous video. And now we will look at an illustrative example and case study to explain how these issued financial guarantee contracts, if they are within the scope of IFRS 17 or Ind AS 117, how they are accounted for. And how does the accounting compare if someone were to apply the financial instrument accounting and not insurance contract accounting. So let's see this, how the accounting is done under insurance contract accounting. So we'll just straight away jump into the case study. And if you are following my channel, you will know that this particular case study is very similar to what we have taken in one of the previous series of videos when I have explained the accounting for issued financial guarantee contract under the financial instruments standard by way of 3-part series of videos. It is there on the channel. In case you have missed that, I will also in the description of this video I'll give a link to those videos as well. I will encourage you that if you can go through those videos, it will help you in better understanding this video and how the comparison between the two sets of accounting is there. But let's see. In this particular case, we are considering a scenario wherein the issued financial guarantee contracts are to be accounted for under IFRS 17 or in the Indian context under Ind AS 117. So this is the fact pattern. In this case, it says that on 1st of January 2022, Mr. A, this guy, has issued a financial guarantee contract to this ABSPL, an entity this ABSPL is holding a portfolio of trade receivable. This is a portfolio of trade receivable which is being held by this ABSPL. And Mr. A, in this fact pattern, is a guarantor. He has given a guarantee for a premium of rupees 300. And as per the contractual terms of the terms and conditions, this is 2022. Almost 3 years later, as per the contract on 31st of January 2025, almost 3 years later, Mr. A, the guarantor, will reimburse this entity for all defaults that ABSPL, the entity, may sustain during the 3-year period between January 2022 through January 2024 or say 1st of January 2025. The 3-year period, in this period, if this entity sustains any losses, then Mr. A will make good those losses arising out of these pool of trade receivable. And this contract is for a 3-year period. Now, the guarantor Mr. A expects to incur a total default of rupees 120 over the 3-year coverage period equally. For simplicity, it is 40 rupees each in the 3 years. In each of the 3 years, 40 rupees is the expected defaults which this Mr. A expects to bear. Assume that, for simplicity, that this expectation holds good and all the defaults were as per the expectations of Mr. A. That means your estimate of the losses as well as the actual losses were exactly the same. So 40, 40, 40 was expectation and the actual losses were also the same. Now, Mr. A, this guy, has determined that it will recognize the contract consideration, the fee which they have received for giving the financial guarantee contract. For this, the 300 rupees of the contract consideration, it will recognize and the deferred profit in P&L on a straight line basis. What does it mean? It simply means that the consideration of 300 and the profit which is arising on the contract, it is to be recognized by Mr. A on a straight line basis. Now, this is the difference from the previous case study in my earlier video. Because we are not dealing with Ind AS 1, the 117 or IFRS 17, This is an additional information given in this case study, wherein it tells you, the facts tells you that you are also informed that the guarantor, Mr. A, applies what is called the GMM model, which is the default model under IFRS 17 or Ind AS 117. It is also known as building blocks approach, BBA. Okay, so of course we will cover Ind AS 117 and IFRS 17 in greater detail in a series of videos, but I'll conceptually explain to you in this case study how this particular GMM model works at a very intuitive level. Okay, but what is given in this particular case is that the guarantor is applying the GMM model, which is the default model in Ind AS 117 or IFRS 17. There are three models: GMM, then there are two more models which are applicable in various specific circumstances, which are a derivation of the GMM model. We are not going to touch upon that in this particular video. We will look at it separately. But the GMM model is something which is being applied by the guarantor A, and the effect of discounting is also given. The effect of discounting, risk adjustment for non-financial risk, and the admin expenses are to be ignored. I'll explain to you when we briefly look at what the GMM model is all about. Okay. Now, given this fact pattern, the question is that if Mr. A were to account this financial guarantee contract under IFRS 17 or 117, how it will be recorded by the issuer, Mr. A. Now, I will briefly just touch upon the GMM model by way of a chart. If you see, the way the GMM model works, that for the guarantor A, if you look at forget about the model, okay? Conceptually, if you look at what will happen in case of an insurance contract, generally, the insurance contracts are long contracts. Say for example, if you look at the life insurance contract, they may be for 10, 15, 20, 30 years. And therefore, in a typical insurance contract, what those will entail? You will have inflows. Let us say this red bar denotes inflows by way of, let's say, the premium which you expect from the policyholder. Then what are this bar represents outflows. It is possible that, let's say, if you have 1,000 policyholders, there may be claim arising out of, let's say, 20 such people out of that 1,000. So what are the expected cash outflows which are there, or which are estimated by the entity out of the pool of the insurance contracts? So your inflows minus outflows minus, there are two specific adjustments which are required under the GMM model. What are these? Logically, it is called, first is the discounting. Your cash inflows and outflows which are happening over a long period of time, the standard requires you to discount them to the present value. So this is the discounting effect. And then there is something called risk adjustment. That is another adjustment which needs to be done. These two, if you look at this point, it says it is assumed to be zero. They are to be ignored. So we will not get into this. Let us, for the simplicity, let us assume that these two are zero. Right? So if you are expecting that 40 into 3, 120 rupees is your expected cash outflow and 300 rupees is your fee income, what is the expected profit? 300 minus 120. This is exactly what you will see here. I have plotted in the graph. 300 rupees is your inflows. 120 rupees is your expected outflow, 40 into 3. And these two we have considered zero as given in the case study. It is assumed to be zero. Therefore, 300 minus 120, 180 would be your expected profit. Now, this expected profit has a new name under the GMM model. It is called CSM, Contractual Service Margin. It is nothing but equal to your unrealized profit on that particular contract. Right? So, as I said, we will not get into this. We will look at the insurance contract accounting at a later point in time. But logically, if you look at in this fact pattern, you have a scenario where you are getting a fee income of 300 rupees. You are expected to incur a loss of 120 rupees by way of the default, which happens, to which you will be responsible, and therefore that will give you 180 rupees of expected profit. This 180 rupees of profit, as you say here, it is given. You expect to record on a straight line basis. That's the sum and substance of the fact pattern of this particular case study. Let's continue the solution on the next slide. So what happens in this case? I brought forward the chart from the previous slide. So given the information in this slide, if Mr. A were to apply the GMM model under IFRS 17 or Ind AS 117 to such issued financial guarantee contract, how the balance sheet will look like? We are first looking at the balance sheet. Next slide, we will look at the P&L. Now, if you look at in a typical insurance contract, what would you expect? What would be the liability of a insurance company or a company or an entity which has issued the insurance contract? If you logically look at liability of the issuer of an insurance contract will consist of two parts. What is that? First, the liability which is already incurred. This relates to past period, if you have not paid yet. So liability which is already incurred, which you have not yet paid, this will be one component of your liability which you need to carry in the balance sheet. And the second part is the expected future liability. So for example, if you look at, in our case, there is a three-year coverage. So if you are computing the liability at the end of year number 1, this liability will consist of, on this date, two parts. The liability for these balanced to future years, which are yet to serviced by the entity, plus for this period, if any loss has happened, the claim has already come, which you have not yet paid. So that unpaid claim will also be part of your liability, which you need to carry at the end of this period. So essentially, at any point in time, the liability from an insurance contract will consist of two parts. Liability for incurred claim, which is the past period, and liability for future periods. Right? So this is exactly the concept which we will apply here. So if Mr. A were to apply the GMM model under IFRS 17, then the extracts of liability carrying amount of insurance contract liability at each reporting period will consist of two things. Liability for incurred claim, this is for past period, and liability for remaining coverage, which is for future period. In our example, the first year and the next 2 years. The liability will consist of that. Now, if you look at this in the fact pattern which we have, we said that the entity is expecting 40 rupees of the default in each of the year. Right? And the case study also says that all the amount which is payable, it is paid after the third year at the end of January 2025. That means for the prior period, whatever is your liability incurred is still unpaid. Right? So what is the liability for incurred claim for each of the period? It will be 40 at the end of, it's a balance sheet item, right? So at the end of year number 1, your liability for incurred claim will be 40, because this is going to be paid only subsequently in January 2025. What about second year? The liability will be 40 plus 40, the 2 years liability, 40 plus 40. And the third year, again, 40 plus 40 plus 40, 120, which will get paid by the end of January 2025. So the liability for incurred claim will be 40, 80, 120 in each of these three periods. What about remaining coverage? Now, remaining coverage will consist of, again, two parts. Estimate of the future defaults plus the deferred profit, which you are yet to realize for future periods. So, for example, at the end of this year, out of the 3 year, 1 year, the service you have already provided. So, you are left with balance coverage for 2 years. So 1/3 of the profit you should recognize, and 2/3 you have to still defer. And in a contract like this, your 300 rupees of your fee and the expected 120 rupees is your expected amount which you need to pay. So your expected profit of the contract is 180 rupees overall for the 3-year period. So this divided by 3, 60 rupees should be your yearly income, because the case study says it is to be recognized on a SLM basis. So therefore 180 divided by 3, 60 should be your yearly income. Let us see this, how your liability for remaining coverage will be computed in each of the 3 years. So I'll explain what it is. At the end of the first year, your liability for the remaining coverage will be 200, which will be consisting of these two amounts. Why? The 40 into 2, you have 2 more years to go for which the expected future defaults are 40 rupees each. So 80 rupees is what you are yet to pay. And what is your deferred profit? Of the total 180 rupees, 2/3 of the profits relate to next 2 years. So 180 into 2/3. So if you compute this, this is nothing. The sum total of these two is nothing but your liability for remaining coverage. Come here, number 2. Now here, what is your estimate of future liability? Now only 1 more year to go. So 40 rupees is your liability for remaining coverage. Why? Because liability for incurred claim you have already covered 40 into 280. So 2 year is already sitting here. The 3rd year liability is sitting here. And then you will have only 1 more year to service further, and therefore you will defer only 1/3 of 180 rupees for the future period. And therefore your liability, total insurance contract liability at each of the reporting period will be sum total of these two numbers for year number 1, sum total of these two numbers for year number 2 and year number 3. So if the entity Mr. A in this case would have applied IFRS 17, then in the balance sheet, it will need to carry the insurance contract liability of 240, 180 and 120 as computed here. Right? This is under IFRS 17 or Ind AS 117 if GMM were to be applied and the fact pattern given in this case study holds good. Of course, it is very, very simplified. When you actually look at the accounting under Ind AS 117 and IFRS 17, you will see there are much more nuances. It is a very simplified version of the accounting which I am explaining here. Now, what about the P&L? This is the balance sheet. Let us see the next slide, how the extracts of P&L will look like. Now, I brought forward this chart and what we discussed in the first slide. So you have 300 rupees of your inflows, 120 of the outflows, an expected profit of 180. Of course, these two elements considered 0 or in this particular case study. Now, with this fact pattern, what would be the extracts of P&L? So profit for the year will consist of what? For any other entity, profit is your revenue minus expenses. So this is how we have to compute what is my revenue, what is my expense for each of these 3 years. Now we know that from an expense perspective, your expected and the actual cost is 40, 40, 40. That's a simple thing. So what is your expenses each of the year? It is 40 in each of the year. Default of 40 per year, expenses which are incurred on servicing the contract, right? What about insurance contract revenue? Now, if you look at a very 10,000 feet without applying the GMM model, or simply you have 300 rupees of fee income. If this were to be recognized on a straight line basis, every year you should have 100 rupees of the revenue. This is what you will achieve, but in a different way. Because the revenue under GMM model, under IFRS 17 or Ind AS 117 will consist of these two components. It is expected default for the year plus the deferred profit, which is earned, the 1/3 of each of the year, which you have already serviced. So 1/3 of 180 rupees is what you will recognize as your profit. So therefore, in this case, the revenue will be 100, which is logically also, as I said, 300 rupees divided by 3, because the case study says on a solemn basis, revenue need to be recognized. But this is computed as 1/3 of the profit which you need to recognize for year number 1 plus the expected default of 40. Okay, this gives 100. Same way, in the next year also, expected default of 40 plus 1/3 related to year number 2. Likewise, year number 3, 1/3 related to year number 3. And therefore, if you look at revenue minus expense, this is all 60 rupees each in the every year. So that means over the 3-year period, 180 rupees is your net profit, net of these two amounts, which is what you are expecting. 300 minus 120, right? Sorry, 120. This is not 180, it is 120, right? So, sorry. Okay. So let me just rephrase it. What we are saying, 300 is your total fee and 40 into 3, 120 is your expense. So your profit is 180, which is divided into 3 parts, 60, 60, 60. So that's how your income statement will be. So simplistically, your income statement is equally apportioned 60 rupees. Now, how would this compare? Because you have seen in these slides, slide number 6 and 7, how your extracts of P&L and the balance sheet will be. But if you compare the same thing with what we would have recognized as part of financial instruments standard, so that's the next slide will tell you how the accounting between IFRS 17 and the financial instrument accounting, how they compare with each other. Of course, the total profitability will remain the same, but the pattern of the revenue recognition will change. Let us see this. What I have done, I have brought forward, I have given you here the QR code of the previous video where we talked about this case study from the perspective of IFRS 9. Okay, so if you scan this, or even this also, any of these, if you scan, you will go to the previous video. Okay, now if you look at that video and if you are following the channel, you would know this slide is something which we captured, wherein we said if the entity would have applied IFRS 9, then from the balance sheet perspective, the carrying amount would have been 200, 120 and 120, which is the higher of these two numbers. If you recall, we have said loss allowance and the amount initially recognized minus the cumulative amortization. I've graded it out just so that you focus on these numbers. Okay, but the detailed explanation is anyway given in this video, which you can go and have a relook at if you have missed it. Okay, now, so under IFRS, from an IFRS perspective, if this same fact pattern would have been accounted under IFRS 9, your balance sheet would have the liability of this much. Whereas your P&L would have been 180 and 0. This we have worked out in the previous case study. Now, if you compare the last two slides where we have computed what is the insurance contract liability under GMM for each of the year was 240, 180 and 200. Now you can see if you compare these two numbers, the liability is not exactly the same. The liability under the two standard, if you account under IFRS 17 or under IFRS 9, the numbers will be different. So the pattern in which you will recognize your liability, and for that matter, even P&L side also. If you look at the way you will recognize the revenue, in the IFRS 9 perspective, you would have recognized income of this aggregating to 180 over the 3-year period. But here it is 60, 60, 60 in each of the year. So still the aggregate is 180, but the pattern of revenue recognition, the timing will change. This is the sum and substance of how the accounting has to happen under Ind AS 117, IFRS 17, and how does it compare with the financial instrument standard. I hope this video was very helpful to you in understanding the crux of how the accounting happens under the two standards. Again, my social media contacts are here. Please feel free, subscribe to the channel, comment on this. If you need any specific topic to be discussed, put it in the comment. I will try my best to make sure that I'll come out with those particular videos. Recently, on my LinkedIn, I put a poll in terms of asking, should I make videos on embedded derivatives, how the embedded derivatives accounting happens? But for one, everybody has said yes, who has responded to the poll. So in times to come, some of those, I will create a series of videos which is deal with accounting for embedded derivatives as well. I hope you like all of this video. Please support the channel by way of subscribing to this, commenting, liking, and maybe circulating it within your WhatsApp group or wherever you think it is appropriate. Anybody who has the requirement for these kind of material and the discussion, please feel free to share with them. Thank you for now. Take care.